Did I mention not all ties are the same? Some ties are a little short. They don't go down very far. This is just the opposite. This one goes down to my knees. Oh my goodness. All right. Top of the morning, Captain Ron here. Today, what I want to do is go through some standard management considerations for your portfolio. And then I'm going to take that Apple portfolio that I did yesterday that was incomplete and finish it. Turn that incomplete portfolio into a complete portfolio, and I'll go ahead and add it to the list of portfolios, and we'll see how that one runs. But it's an interesting one. It's one that looks very stable. Pretty cool portfolio. It's interesting to go through the process, what comes out. That one just started with Apple, so that is going to be the final Apple portfolio. And with that, a quick disclaimer. Remind everybody this is for educational and entertainment purposes only. And then with the long tie, we'll get into it. All right. Let's get into how we mitigate some of the risks of a portfolio. And we'll use the Apple portfolio as an example on how we do this. Remember, we went through modern portfolio and we talked about some of the risks of the modern portfolio. And we're going to go through some steps to mitigate those risks. And if you remember, I came up with this portfolio at the end, which had a -2 sigma number of -4.5, which looks like a great portfolio. It's going to make 15%. However, we haven't checked for diversification, and I can see right out the top of the bat, we've got too much concentration in several of these companies. We want to get that concentration to under 5. That I had this screen here, which is a bit rude, so we're going to finish this now. The first rule is the 2%, 5% rule. In this case, it's mostly big stocks, so we're going to just go 5%. The rule, simply stated, is don't put more than 2% in any high-risk company, or don't put more than 5% in any stable company. That way, no matter what the company, you don't care if they're a brand new pharmaceutical or Apple, they could both go bankrupt. It's possible. The way they usually do it is take on too much debt. They grow too fast, the market doesn't act the way it should, debt's overwhelming, and next thing you know, your stock is worthless. You think the market's rigged. Well, it's not rigged. It's done on purpose that way. We need to make sure we don't invest in any one stock more than 5%. You need to diversify. You need sector diversification. You don't want everything in tech. Tech does great, but it also is hugely volatile. You want to spread that out, different sectors. And a good rule of thumb is don't put more than 35% or so in any one sector. I know some portfolios are going to be concentrated a little bit, and that's okay, but let's keep it down below 35. World concentration. The truth is, concentrating everything in the U.S. is probably not the best idea all the time. It turns out outside the U.S. in some years does much better. We want to set some of our investments outside of the U.S. more than 10%, preferably in that 20 to 30% range. However, we don't want to go any more than that, because the truth is the U.S. is the best place to invest. Too much equity. We don't want to put too much into stocks. We want to have at least 5%, preferably 20% or more in bonds or bonds equivalent. You have some bonds, and we use this money specifically during Black Swan events where the market crashes, that Black Monday event. And on Black Monday, we don't want to be sad that the market crashed. We want to take a good portion of those bonds and buy that equity. So we buy super low. When the market recovers, we're going to make significantly more money than we would have if we didn't have those bonds. Allocation. So when we look at the modern portfolio theory, we're going to run our mouse over and look at that efficient frontier line. And it's going to give some very specific numbers on what to allocate. 20% here, 3% there. And it turns out that is not the best way to make a portfolio. The way to make a portfolio is to look at those targets that do well and then come off the frontier a little bit. Set those allocations to be mostly the same. So we got 20 stocks, make them all 5%. Go pick the 20 with the efficient frontier, but then set them all to 5. You'll do better in the future because as some go up, some go down. Our market entry, we're not going to hit that. Going into the future, we can't hit that line. So we want to come out and make them roughly the same. When we get done, we want to make sure we jot down those rules. Let's write those rules down ahead of time, and that'll help manage the emotions during this roller coaster ride. You are better off dollar cost averaging on the way in. Probably want to spread those buys out over time. If you're actually saving actively going into the future, that takes care of this because your dollar cost averaging on the way in. Buy a fixed amount every month. If you're putting in a bulk amount, break it up over 3 time periods, make them each like a quarter, so 3 buys throughout the year. Dollar cost averaging does help mitigate the downside risk. The risk is that when you get in, the market immediately drops. Exit execution risk. The market drops right before you need to pull money out, right before retirement, right before you buy a house, right before some big expenditure. So you need to plan on your big expenditures like retirement, like buying a house, and 5 years before that, You want to take that money and reduce that risk way down. So go to 60-40 or better, or 40-60. Now, I don't recommend going below 40-60. If you've got plenty of money, go down to 40-60. If you're still saving, you still need to acquire some more, go to 60-40. But do it at least 5 years before that expense. The other thing is on execution. Keep at least 1 year's expenses in cash. And when the market's high, go pull out extra. Go pull out 2-3 years of expenses in cash so that during that market dip, you don't need to go be selling equities to pay for your life. And then rebalance, reallocation. We want to rebalance typically at least every 2 years on a buy and hold portfolio. Rebalance every 2 years or on big market swings, preferably on big market swings. So when the market goes way up, we want to sell a little stock, buy a little bonds. When the market goes way down, we want to sell a little bonds, buy a little stock. And also, you don't want to rebalance too often. Once a quarter. Once a quarter is the maximum. If you haven't rebalanced in 2 years, go rebalance. Monitoring. We want to set expectations for our portfolio. We want to know the expectations of each of our individual stocks, and we want to monitor those. Things do happen. When we see current performance not matching what our assumptions were, we're going to go ahead and pull out of that and make a change to the portfolio. We'll sell one, buy another one, replace it with something else that looks better going into the future. And we might go look at this annually. Annually, go look at your holdings. Make sure they're all acting sort of okay. Look at the big market picture. If the whole market's down and they're down, well, that's just the way it works. But if everything's up and one of them's out of whack, go ahead and sell it, replace it with a different one. I iterated several times, and I came up with this portfolio down here. We started off with Apple and several other things. I set the concentration to be max of 5%. I kept adding components so that I got the answer I wanted. Each step of the way, I'll load this thing into Morningstar, and they've got a portfolio manager that'll very quickly break down our allocation. The first time I went through, it was 100% North America, so I needed to go buy something outside of North America. I went in with 20% bonds. It's not a perfect iteration. I could probably do it a few more times, but I got to a point where it was actually pretty good. I got the concentration down to 5% for all the companies. I got the sector maximum, technology, down to 30%. I did note that materials, energy, and utilities were left out. These could be added. I could add 3 more stocks in that cover these 3 areas, which is probably be the next step I do. I like the way this one ended up. The numbers are round. I like that. I did end up with about a little more than 20% international. We can see that we are spread out pretty good, mostly large. There's some medium, some small, and no small for Morningstar, still very big. This portfolio ended up being amazingly consistent. So the expected returns went up from 15 to 19%. Standard deviation actually came down to 10% and change. And that put the minus 2 sigma at minus 2.76. This looks awesome. This is a portfolio that's just going to go up. It's going to wiggle a little bit on the way up, but it's just going up. So I'm going to go ahead and add this to our list of portfolios. I'm calling it the Apple portfolio because I started with Apple and built a portfolio around it. Let's see how this goes into the future. The rules for managing the Apple portfolio. I should buy in over 9 months, do 3 trades, a third each quarter. For the example, I'm just going to buy in once, and the market's way down today, so probably a good day to buy in. I'm going to rebalance every 2 years around market swings. Very typical of this buy and hold portfolio. I'm going to monitor the performance annually, and any entity that is not acting as suspected, I will go research and remove and replace as needed. This is saving for retirement, so I'll focus on retirement, and when I'm 5 years out, I'm going to go ahead and reduce that equity and bring up the bonds. And I might, at that point, maybe introduce a second bond fund. So sell 20% of the stocks, buy another bond fund, get this thing down to 60-40. In summary, to offset the risk of the historical nature of modern portfolio theory, we're taking some mitigation steps. So first of all, we're limiting concentrations and we're ensuring diversification. We're going to monitor the portfolio and ensure the results match what is expected and adjust as needed. We're going to have a rebalance reallocation plan, and we're going to write down these rules so that when our emotions get high, before we go do any trades, before we do any panic selling, let's go look at those rules and let's go follow those rules. With that, let's go check out the mountain one more time. Mount Spur. Those are the steps you need to take to mitigate the risk in your portfolio. We need to ensure diversification, and we need to monitor that portfolio going into the future. With that, I will bid everybody top of the morning. Adieu. how long this thing is. It goes on forever.